Picture the lobby of a glass tower in September 2008. A few people in suits drift toward the doors with cardboard boxes. In movies, that box is family photos. In real life, what mattered most was invisible. A web of promises, contracts, stacked on top of one another. That's the part most people missed about 2008. We were told it was bad mortgages. And yes, millions of shaky loans were real. But the reason a housing problem became a global heart attack was that finance had built a second city on top of those mortgages. A derivative city. A city made of agreements that said, in one form or another, if this happens, you pay me. Now, let's make derivatives boring again. A derivative is simply a contract whose value derives from something else. The price of oil, the level of interest rates, the default risk of a borrower, the movement of a stock. The basic idea is old. Lock in a price, reduce uncertainty, keep your business stable. In modern form, an airline may hedge fuel costs. A company with customers abroad may hedge currency swings. A bank may hedge interest rate risk. So why do headlines scream, $600 trillion time bomb? And why do some people argue the next crash could be worse than 2008? Here's the twist. In modern markets, you don't always have to own the underlying thing to write contracts about it. You don't have to hold a bond to buy protection on that bond. You don't have to own a stock to gain exposure to its moves through a swap. Once that becomes normal, derivatives stop being only insurance. They can also become a way to take huge positions with little upfront cash, leverage with a polite name. Incentives do the rest. Banks get paid to create and trade more contracts. Traders get rewarded for short-term gains. Investors chase yield when safe, returns feel disappointing. And for years, a big slice of this world lived over the counter. Private deals between institutions, where risk was harder for outsiders to see. If profits look smooth and the plumbing is hidden, what forces the system to slow down? By 2008, the market wasn't just holding mortgages. It was holding layers of claims on mortgages and then insurance-like contracts on those layers. When defaults rose, the panic wasn't only how bad are the loans. It was who owes who and can they pay? That fear has a name, counterparty risk. It's the moment you realize your safety net is only as strong as the person holding the other end. Fast forward to today, and we need to be precise because this topic gets exaggerated fast. The derivatives market did not vanish after 2008. The plumbing changed, more clearing, more margin, more reporting for many standardized products. But the world still runs on derivatives because the world still runs on risk, and everyone wants to move that risk somewhere else. Here's a grounding number. As of June 2025, the Bank for International Settlements reported about $846 trillion in outstanding over-the-counter derivatives notional. The gross market value, closer to what those contracts are worth today, was about $21.8 trillion. Those numbers are not the same thing, and that difference is why the story is both less apocalyptic than the memes and still worth taking seriously. Notional is a reference amount used to calculate payments. It is not money that will explode. Many positions offset each other. Netting and collateral matter. But notional does tell you something important. How much interconnection and potential leverage the system can carry when everything is calm. The lesson of 2008 wasn't derivatives are evil. The lesson was that complexity plus leverage plus opacity can turn a normal shock into a chain reaction. So the question for this video isn't, are we doomed? It's, where could the next chain reaction start? And why might it travel faster than it did in 2008? Because markets today are more automated, balance sheets are more optimized, and trust can freeze in hours, not weeks. In the next part, we'll build this story from the ground up, starting with how derivatives were meant to reduce risk, then how 2008 revealed hidden leverage, and finally where modern fault lines could rhyme with that history with me. To understand why derivatives can be both the seatbelt and the skid on the highway, you have to start with why they were invented. Long before anyone wore a Patagonia vest on a trading floor, people were trying to tame uncertainty. A farmer wants to know the price they'll get after harvest. A miller wants to know the price they'll pay. A merchant wants to know they won't be ruined by a storm, a war, or a sudden shortage. The earliest versions of "let's agree on a price today for something delivered later" weren't casino chips. They were survival tools. But the moment you make a contract tradable, you also make it tempting. If a contract helps you reduce risk, it can also help you take more risk because it lets you control outcomes without owning the underlying thing. That's the core trade-off. It's not good versus evil. It's incentives. Modern derivatives really took off when the world stopped being stable by policy design. After the old post-war monetary order broke down and interest rates and currencies began swinging more freely, companies and banks needed tools to manage the new volatility. That demand is one reason interest rate derivatives became the giant of the derivatives world. In fact, by June 2025, interest rate derivatives made up about 79% of all OTC derivatives notional outstanding. And that right there is an important clue for beginners. Most derivatives aren't about some mysterious Wall Street monster hiding under the bed. They're often about very plain problems like, what will my borrowing cost be next year? Or what happens if rates fall? But the same tool that helps a business plan can also help a trader lever up, because many derivatives require only a fraction of the underlying exposure in upfront collateral. If your personal budget can't handle a $10,000 swing, but you can get exposure to a $10,000 swing with only $500 down, you can see why the room fills up quickly. This is where the 2008 story rhymes. Subprime mortgages were a spark, but the accelerant was the machinery built on top. Mortgage-backed securities, then increasingly complex repackaging, then derivatives like credit default swaps that acted like protection on those products. When things went bad, the terrifying question wasn't only how many homeowners will default. It was, will the protection actually pay? That's counterparty risk. Your hedge only works if the other side can perform. The AIG episode is the cleanest illustration because it wasn't abstract, it was mechanical. In mid-September 2008, credit rating downgrades triggered collateral calls tied to AIG's credit default swaps that the company could not meet. In the Financial Crisis Inquiry Commission's account, those downgrades triggered an additional $13 billion in collateral calls on AIG financial products CDS, and the liquidity demands quickly piled up. That's the nightmare version of a derivative. Not necessarily a giant loss on paper at first, but a sudden requirement to post cash right now in the middle of a panic when cash is hardest to find. After 2008, regulators didn't shrug and move on. The G20 era reforms pushed more standardized derivatives into central clearing, expanded trade reporting, and raised expectations around margin and risk management. Progress reports from global standard setters describe central clearing requirements being in force across many major jurisdictions and continued work on trade repositories and reporting. The goal was straightforward: less hidden bilateral exposure, more transparency, and fewer AIG surprises. But reforms don't delete incentives, they redirect them. Central clearing can reduce one kind of domino effect, yet it can also concentrate risk in key nodes, like clearinghouses, which become critical plumbing. And large parts of the market remain over-the-counter, customized, and harder to see from the outside. The BS data is a reminder of scale and interconnectedness. The notional value of outstanding OTC derivatives rose to about $846 trillion at June 2025, while gross market value, much closer to the what's it worth today number, was about $21.8 trillion. Notional is not a bomb sitting in a room, but it is a measure of how much contract exposure exists and how much collateral may need to move when markets lurch. If you want a modern parable for hidden leverage in plain sight, look at swaps and the Archegos collapse. Here's the simple version. A total return swap can give you the economic exposure to a stock, up and down, without you directly owning the shares. That could be perfectly legitimate. It can also make your real size less visible, especially if you do it with multiple banks. Regulators have described how this structure allowed exposures to build in a way that was difficult to see and unwind smoothly. When prices moved against Archegos, margin calls hit. Banks began liquidating, and losses cascaded through the same who channels that made 2008 so contagious. The SEC has described the use of billions in total return swaps purchased on margin as part of its allegations in the Archegos case. Credit Suisse's own report put its loss at about $5.5 billion from the Archegos default. European regulators later summarized that the forced unwind contributed to more than $10 billion in losses across counterparties. Now, zoom out from hidden leverage to fast feedback. The markets didn't just keep derivatives. They also kept inventing products that behave like spring-loaded furniture. In February 2018, a sudden volatility spike triggered what traders nicknamed Volmageddon, when short volatility exchange-traded products suffered catastrophic one-day losses, more than 90% in some cases. That episode mattered not because it toppled the world, but because it demonstrated something uncomfortable. When a strategy is popular and mechanically forced to buy or sell into a move, it can amplify that move with no villain required. It's just math plus crowded positioning. That brings us to the newest debate in the "could this make a sell-off worse?" category. 0 days to expiry options, contracts that expire the same day. These started as tools for hedging around specific events, but they have grown into a massive slice of index options trading. Reporting around 2024 showed 0 DTE S&P 500 options becoming the most traded in the fourth quarter, at times surpassing all other expirations combined, around 51% of total S&P 500 options volume. By May 2025, some coverage cited 0 DTE, making up over 61% of S&P 500 options volume. And later reporting in 2025 pointed to 0 DTE representing around 60% of S&P 500 options volumes, with record daily volumes in certain months. To be clear, there's real disagreement about how destabilizing 0 DTE is. Plenty of the flow is hedging, and market makers are designed to absorb and manage it. Still, the concern is plausible. When a large portion of trading is ultra short-term, hedging flows can become more sensitive to intraday moves. In plain English, it can create moments where the market isn't just reacting to news. It's reacting to the hedging response to reactions to the news. A hall of mirrors, but with invoices. Now layer in a slower-moving stress that isn't a one-day spike. Commercial real estate, especially offices. Remote and hybrid work changed demand in a way that many leases and loans were not designed for. At the same time, higher interest rates changed refinancing math. Analysts have pointed to a large maturity wall of CRE debt coming due across the mid-2020s, which creates pressure to refinance at higher rates or accept lower property values. In the securitized market, updates in late 2025 showed overall CMBS delinquency around the mid-single digits, with office often singled out as a persistent problem area. This isn't guaranteed to be a systemic crash. It's more like a slow leak that can become a problem if it intersects with something faster and more fragile. So here's the thought experiment that ties everything together without assuming doom. Imagine a visible shock hits a real economy corner like offices. A few large defaults, lenders tighten, headlines turn sour. Equity markets start sliding, not because the world ended, but because people suddenly disagree on prices. On a day like that, ultra-short-term options activity can intensify intraday moves as hedges adjust quickly. Meanwhile, somewhere in the background, a big player is running a leveraged strategy through swaps that looks contained to any single counterparty, but is enormous in aggregate because multiple institutions are each seeing only their slice. The market drop triggers margin calls. Assets get sold to raise cash. Those sales push prices further. New margin calls arrive. Counterparties begin to wonder who's next. Liquidity, like party guests at 1:58 a.m., suddenly finds reasons to leave. Notice what made that scenario scary. It wasn't one bad asset. It was the interaction of leverage, speed, and trust. That's the real lesson from 2008 and from the smaller modern blowups. The system is most fragile when everyone believes their risk is hedged, until they discover the hedge depends on someone else's balance sheet at the worst possible moment. And here's the relatable part, because this doesn't have to live in the clouds. We've all done a derivatives-ish thing in real life. Fixed-rate rent is a hedge against future rent spikes. Buying a flight early is a hedge against price changes. Insurance is a hedge against disaster. The problem starts when you can insure something you don't actually own, or when you can borrow so much that a normal bad day turns into an emergency. That's why complexity plus leverage is the danger sign to remember. It's not about fearing every financial instrument. It's about noticing when the system rewards people for turning risk into a product and then selling that product to someone who thinks it's safety. So what does that leave us? Back in 2008, the image everyone remembers is the cardboard box. But the deeper memory, the one markets carry in their bones, is the moment trust evaporated. Not trust in the economy in some vague sense. Trust in the plumbing. Trust that the contract on the other side of your hedge would still be honored when it mattered. Trust that the risk you thought you had moved was actually moved. And that's why this topic keeps coming back. Derivatives didn't cause the human urge to take risks. They simply gave that urge a high-speed highway, better headlights, and sometimes no guardrails. Here's the balanced truth that doesn't fit neatly into doom thumbnails. Derivatives are not automatically a time bomb. They're also not automatically safe because everyone learned their lesson. They're a tool set, a huge one, a necessary one. And like every powerful tool, the danger isn't in the existence of the tool. The danger is in how incentives shape its use, especially when the system is calm enough for people to forget what panic feels like. When the world is quiet, leverage feels like intelligence. It feels like you found a cheat code. When the world is noisy, leverage is just gravity. That's why the biggest question isn't, will derivatives explode? It's where the hidden pressure points. Because crises rarely arrive wearing a sign that says, I am a crisis. They arrive as something ordinary that becomes contagious. A refinancing problem, a volatility spike, a margin call that hits at the wrong hour, a big player trying to unwind without admitting they're unwinding. And then the same old story. Everyone scrambles for cash at the same time, and suddenly the most expensive asset on earth is not a stock or a building, it's liquidity. The part one want you to take away, without fear, without drama, is this: complexity and leverage don't announce themselves as danger. They announce themselves as sophistication. They show up as reassuring phrases. It's hedged. It's market neutral. It's diversified. It's just a swap. It's just insurance. And sometimes those statements are true. But in every major blow-up, someone, somewhere, discovered that hedge didn't mean immune. It meant dependent. Dependent on models. Dependent on correlations behaving. Dependent on funding staying cheap. Dependent on counterparties answering the phone. If you're a smart beginner, here's the simple mental model. A derivative is a promise with conditions. The moment the conditions are triggered, the promise can demand cash fast. And when lots of promises demand cash at the same time, even healthy institutions can start behaving like they're in trouble because they're forced to sell what they can, not what they want. That's the brutal difference between losses and forced selling. Losses can be endured. Forced selling can become a spiral. Now, let's keep this lighthearted for a second, because if you ever want a quick shortcut for whether something is risky, ask yourself one question. If I had to explain this to my friend in 3 sentences, could I? If the answer is no, that doesn't automatically mean it's bad. It just means you're trusting someone else's understanding. And in finance, trusting someone else's understanding is often how the bill finds you. You don't need to become an options trader or learn Greek letters to be safe. You just need to respect a few patterns history repeats. When returns look smooth, check what's being ignored. When everyone is using the same strategy, check what happens if it reverses. When a product feels like it removes risk, ask where that risk went. When something relies on cheap funding, remember cheap funding is a mood, not a law of physics. And now, I promise you one very controversial statement. And I'm going to put it right here, because it's the kind of line that annoys people on both sides of the debate. Most financial innovation is not about reducing risk. It's about hiding leverage well enough to sell it. That's not a claim that every new instrument is a scam. It's not an attack on everyone in finance. It's a blunt historical observation about incentives. The market rewards whatever can be packaged, priced, and distributed. If a structure makes risk appear smaller than it is, if it turns something fragile into something that looks sturdy, that structure spreads fast because it's profitable to spread. And when it breaks, the story isn't a genius made a mistake. The story is a system made money by turning risk into a product, and the product did what products do. It sold until it couldn't. So what do you do with that? As a normal person who also wants to live their life, you don't panic. You don't swear off all markets. You don't buy canned beans and move to a bunker because someone said $600 trillion. You simply develop a healthy suspicion of anything that promises safety and returns without trade-offs. You favor transparency over cleverness. You keep your own leverage low. Personal debt is the most underrated derivatives exposure most households carry. You build buffers. You diversify in ways you actually understand. And you remember that financial history isn't a series of random accidents. It's a museum of incentives. Because here's the part nobody likes to admit. The next crash usually looks obvious after it happens, not before it happens. Before it happens, it looks like a contained issue, a localized problem, a one-off. That's why watching incentives is more useful than watching headlines. Headlines tell you what already moved. Incentives tell you what is likely to move next. And if you've been watching this and thinking, okay, but how do I know what to trust? You're already doing the most important thing. You're asking how the machine works instead of just staring at the blinking lights. Now I want to hear from you, because the best education on this topic isn't a textbook, it's lived experience. Have you ever owned something you didn't fully understand and only realized the risk when it started moving against you? Have you ever worked somewhere that relied on "it'll probably be fine" as a risk strategy? Have you ever watched a situation go from calm to chaos just because one key player couldn't meet an obligation on time? Drop your story in the comments. Even if it's small, personal finance, business cash flow, investing, a loan, a contract with fine print, anything where the real risk was hidden until it wasn't. I read the comments and I reply. And if you leave enough detail for me to understand your situation, I'll reach out in the replies and we'll talk through what the risk actually was, what the incentives were, and what you do differently next time. Because that's the point of this channel. Not to scare you, not to flex jargon, to give you a map that says, when you see complexity, ask why. When you see leverage, ask who's funding it. When you see safety, ask what it depends on. And when you see a system designed to monetize risk, don't be the person holding the cardboard box while someone else walks away with the bonuses. If you want more videos like this, finance explained through history, clearly, without the drama, subscribe. And comment derivatives if you want a follow-up that breaks down the most common instruments in plain English and how they show up in the real world without you even noticing. Until next time, stay curious, stay skeptical, and don't confuse complex with safe.